A vote is expected today as the Liberal government looks to change the capital gains tax, which will add close to $20 billion to the federal purse over the next 5 years.
And here to explain what this means and how we can best prepare, we're joined by money expert Kelley Keehn. Kelley, good morning.
Good morning, Carolyn and Jeff. Can I just wish my Edmonton Oilers well this week while I'm in Toronto? Please, please, please. Yes.
We all got our fingers crossed
I
for
know.
Canada's team here, yes. All right, to begin, can you explain for us exactly what is a capital gains tax and I guess the difference between a purchase price and sale?
Yeah. So let's first start with something you might be familiar with. You earn $100 of income, right? We're familiar with that. You have to include all of that. That's all taxed. If you, let's say, got a GIC, some people are familiar with that too. $100, let's say you earned $5 on that. You have to include all of that. It's 100% tax. That's called your inclusion rate. Now, let's say you spent $100, you bought a stock, and you sold it for $200. Now, you've made a $100 gain. You would only have to include $50 into your inclusion, into your taxes, and you'd be taxed at your marginal tax bracket. Now, this gets very complicated even as I'm talking about this, right? So here's the board. You're looking at basically what was the price that you bought something at, and then you sold it for. Now, it's not quite as simple as that, Carolyn and Jeff. It is if it's maybe a mutual fund or a stock or something of that sort, but if it's something other than your principal residence, it's a cottage, it's an investment property, now you have the expenses. Did you renovate it? What were the realtor fees, the closing costs? So there's a lot that goes into it. Now, that's what it is today, 50% inclusion rate. Now it's going up, as we know. That's the big conversation. And there is a lot of complexity around this, guys. Yeah.
We need that iPad that Mike Yanni had at the top of the show calculating all this. Right. All right, so let's delve deeper into these proposed changes and who they are aimed at.
Right. So the government is saying that they're aimed at the wealthy. A lot of people are saying a lot more than just the wealthy are being hit, right? We're hearing doctors speaking out saying that if you have a corporation or things of that sort. Just on the other board as well, this does not affect RSPs or your principal residence. So what you're seeing right now is the new inclusion rate would be over $250,000 of capital gains. It goes up from half to 2/3. So that means that you're paying more tax. Again, aimed at what the government is saying is the wealthiest. But a lot of people are really speaking out saying, look, they saved well. This is wealth that's supposed to go to their children. Or if you're a small business owner, you don't have a pension. You don't have benefits. You don't have any of that. So now that is going to be taxed at that higher rate. So this is where a lot of conversations are coming out.
Yeah, and from what I've seen and reading, a lot of people think 2/3 is a little too punitive over, $250,000. And that $250,000 threshold, really, I mean, with housing prices now, they've gone up. Is it really just targeting the wealthy?
Right.
Those seem to be, I think, some of the big questions in debate. So what impact do you think are these new rules going to have on Canadian families, do you think, Kelley?
Potentially big impacts. So this is where, you don't want to panic right now. You really want to talk to professionals and things of that sort. But let's walk through a little case study of something that was in the news recently as well. So this was an older woman who gifted some of her property to her grandkids, right? A lot of parents are doing that, or grandparents are trying to help them out, save them from rent. What she didn't realize is it's what's called, in the eyes of Revenue Canada, a deemed disposition when you gift something that is not your principal residence. So even though she didn't sell anything, she gifted it to her kids, it actually it occurred at a $40,000 tax bill for her that she was shocked about. So this is something that's really important. If you're gifting, you've got to talk to a professional. If she would have sold the land, she would have had money to pay for the tax. So a lot of people don't realize this. At death, again, if it's not a principal residence, there would be that deemed disposition. So if you own a rental property, you have stocks, you have things of that sort, talk to a professional. Maybe you need some life insurance that would cover those capital gains. Because let's say that family cottage has been in your family for generations. Now, all of a sudden, that tax would be due at death, and maybe the kids don't have the money to pay for it.
Okay. So in a minute or less, how can we help shelter and protect our assets?
You've got to talk to someone. So if this, you think that this affects you, you have a corporation, you have a trust, you have something that would be affected that maybe you are going to sell, really look at talking to a tax professional and or a financial planner. There are some things you may be able to do now to crystallize gains, things of that sort, but do you have the money to pay the tax to do that? So guys, I wish this wasn't complex, but it is, and it really depends on your situation. It's not just about you, it's about you and your family. It's about that generational savings and wealth. So seek some professional advice.
All right, some great advice there from Kelley Keehn. As we mentioned off the top, a vote is expected on this as early as today, so some really timely and relevant information. Kelley, good to see you.
Always a pleasure. Thanks, Carolyn and Jeff.
Thanks.